The warning signs are everywhere. Central banks are moving gold at unprecedented rates. The Federal Reserve just signaled something that should terrify anyone holding cash. And if you're not paying attention to what's happening in the physical gold market right now, you're about to learn a very expensive lesson. Let me show you exactly what's unfolding, because what I'm about to reveal isn't speculation. It's documented fact, and it's happening faster than most people realize. Right now, gold is trading above $4,300 per ounce. That's not a typo. We've blown past every resistance level that analysts said was impossible just months ago. But here's what nobody's talking about. The price you see on your screen isn't reflecting what's actually happening in the physical market. There's a disconnect forming, a dangerous one, and it's the same pattern we saw right before every major market crisis in modern history. Let me take you back to 1971. Nixon closes the gold window. The dollar becomes pure fiat currency, backed by nothing but faith in the U.S. government. Gold was $35 an ounce. Within 9 years, it hit $850. That's a 2,300% increase. But here's what most people don't know about that period. The real move didn't happen gradually. It happened in violent surges, each one triggered by a loss of confidence in the system. The people who waited, who said, "I'll buy when it pulls back," never got their chance. By the time they realized what was happening, gold was already at $600, then $700, then $800. They kept waiting for the dip that never came. Fast forward to 2008. The financial system is collapsing. Lehman Brothers goes under. Bear Stearns evaporates. AIG needs a government bailout. And what does gold do? It doesn't crash with everything else. It consolidates, builds energy, and then explodes from $800 to $900 in less than 3 years. But again, the real story isn't the price. It's what was happening behind the scenes. Central banks, the same institutions that had been selling gold for decades, suddenly reversed course. They became net buyers, not small buyers, massive, aggressive buyers. They saw something coming that the public didn't understand yet. Now let's talk about what's happening right now, because this is where it gets really interesting. The World Gold Council just released data showing central bank purchases hit levels we haven't seen since the Cold War. We're talking about hundreds of tons per quarter. China's central bank, after a 6-month pause that had everyone convinced they were done accumulating, just resumed buying. Not tentatively, aggressively. Why would China do that? Why would any central bank pay record prices for gold when they could wait for a pullback? Because they know something. They're seeing the same data you and I can see, but they're acting on it while everyone else is still trying to figure out what it means. The U.S. national debt just crossed $36 trillion. That's trillion with a T. The interest payments alone are now over $1 trillion per year. Think about that. We're paying more in interest than we spend on defense, more than we spend on Medicare. We're paying interest on money we borrowed to pay interest on money we borrowed decades ago. This is a debt spiral, and there are only 3 ways out: default, inflate, or grow your way out. Default is political suicide. Growing at a rate that outpaces debt accumulation is mathematically impossible at this point. That leaves one option: inflation. And that's exactly what we're seeing. The Federal Reserve can talk about fighting inflation all they want, but their actions tell a different story. They're trapped. If they raise rates too high, they crash the economy and trigger a debt crisis. If they keep rates too low, inflation spirals out of control. They're trying to thread a needle in a hurricane. Meanwhile, the BRICS nations are building an alternative system. They're not just talking about it anymore. They're implementing it. Trade settlements in yuan, gold-backed payment systems, bilateral agreements that bypass the dollar entirely. Saudi Arabia just let their 50-year petrodollar agreement expire. That's not a small thing. That's the foundation of dollar dominance crumbling in real time. For half a century, if you wanted to buy oil, you needed dollars. That created automatic demand for U.S. currency. That demand is evaporating. Now, I want to pause here for a second because this is important. If you're sitting on $100,000 or more in retirement accounts, there's something you need to know about gold IRAs. I put together a free guide that breaks down exactly how they work, how you can get physical gold into your retirement account without triggering tax penalties, and what the process actually looks like. It's in the description below. No pressure, but if you're thinking about protecting your retirement savings, it's worth a look. All right, back to what's happening in the market, because this next part is crucial. The COMEX, the exchange where gold futures are traded, is showing something alarming. The ratio of paper gold to physical gold has never been higher. For every ounce of actual gold in the vaults, there are dozens of paper claims on that same ounce. It's a fractional reserve system, just like banking. And just like banking, it works fine until everyone wants their gold at the same time. We're starting to see the early signs of that stress. Delivery requests are increasing. Premiums on physical gold are widening. The spread between paper gold and physical gold is growing. That's not normal. That's a warning sign. Let me tell you a story about what happened in the silver market back in 2021. Retail investors on Reddit noticed the same thing. Massive paper positions, relatively small physical supply. They started buying physical silver, not futures, not ETFs, actual metal. And within weeks, premiums exploded. Dealers ran out of inventory. The U.S. Mint had to ration production. Now imagine that happening in gold, but with central banks and sovereign wealth funds doing the buying instead of retail investors. The scale would be exponentially larger. The impact would be catastrophic for anyone caught on the wrong side. And here's the thing. It's already starting. Look at what happened in November when the government shutdown concerns emerged. Gold surged to $207 per ounce. Not because of the shutdown itself, but because of what it represented. Political dysfunction, fiscal instability, the inability of the system to function properly. The market resolved that crisis, and gold pulled back slightly. But it didn't give back the gains. It consolidated at a higher level. That's not bearish. That's a bull market taking a breath before the next leg up. Now let's talk about the supply side, because this is where things get really interesting. Gold production peaked years ago. The easy gold has been mined. What's left requires deeper drilling, more expensive extraction, and longer development timelines. Meanwhile, demand is accelerating. Industrial demand for gold is increasing. Electronics, medical devices, aerospace applications. These aren't discretionary uses. These are essential applications where gold's unique properties can't be substituted. That creates a floor under demand that didn't exist decades ago. Investment demand is surging, not just from central banks. Institutional investors are allocating to gold at levels we haven't seen before. Pension funds, endowments, family offices. The smart money is moving. And then there's jewelry demand, particularly from Asia. India and China represent over half of global gold jewelry demand. As their middle classes grow, as wealth increases, that demand isn't going away. It's structural, cultural, and deeply embedded. So you have declining supply, increasing demand across multiple sectors, and a monetary system that's showing cracks. What do you think happens to price? But here's what most people miss. The real move in gold doesn't happen when things are bad. It happens when people realize things are bad. There's a lag between reality and perception. And we're in that lag right now. The data is screaming warning signs. Debt levels are unsustainable. Currency debasement is accelerating. Geopolitical tensions are rising. The financial system is more fragile than it appears. But most people are still operating under the assumption that everything will work out fine, that the system will hold together, that someone will fix it. They won't. Because the problems are too big, too structural, and too politically difficult to address. The path of least resistance is inflation. Print money, devalue debt, and hope the public doesn't notice until it's too late. Gold knows this. That's why it's at record highs. That's why central banks are buying. That's why the smart money is positioning now, not waiting for confirmation. Let me give you another historical example. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's over $3,000 in today's dollars. We're already past that level. But here's the key difference. In 1980, the U.S. had options. Interest rates could go to 20%. The government could tighten fiscal policy. The dollar was still relatively strong globally. Today, none of those options exist. Rates can't go to 20% without triggering a debt crisis. Fiscal policy can't tighten without causing a recession. The dollar's global dominance is being actively challenged by multiple nations simultaneously. We're in uncharted territory, and in uncharted territory, gold is the map. Now, I want to address something that I hear all the time. Gold doesn't pay dividends. It doesn't generate cash flow. Why would I own it? That's the wrong question. The right question is, what happens to your dividend-paying stocks when the currency they're denominated in loses half its value? What happens to your cash flow when inflation runs at 10% or 15% or 20%? Gold isn't an investment. It's insurance. It's a store of value that has survived every currency collapse, every empire's fall, every financial crisis in human history. It's not about making money. It's about not losing it. And right now, the risk of losing it in traditional assets is higher than most people realize. Stock valuations are stretched. Bond yields are negative in real terms after inflation. Real estate is priced for perfection. Cash is being debased by design. Where else do you go? What other asset has no counterparty risk, can't be printed, can't be debased, and has been recognized as valuable for 5,000 years? The answer is obvious, but most people won't act on it until it's too late. They'll wait for confirmation. They'll wait for the mainstream media to tell them it's safe. They'll wait for their financial advisor to recommend it. By then, gold will be $5,000 an ounce, or $6,000, or higher. And they'll be the ones asking, should I buy now? While the people who acted early are asking, should I take profits? Here's another thing to consider. The gold market is tiny compared to other asset classes. The entire above-ground gold supply is worth about $15 trillion. That sounds like a lot until you compare it to global stock markets at $100 trillion, or global real estate at $300 trillion, or global debt at $300 trillion. If even a small percentage of capital flows from those massive markets into gold, the price impact would be enormous. We're not talking about 20% or 30% gains. We're talking about multiples. And that flow is starting. You can see it in the ETF data. You can see it in the futures positioning. You can see it in the premiums on physical metal. The early movers are already in. The question is whether you'll be early, on time, or late. Let me tell you what late looks like. Late is 2011, when gold hit $900 and everyone suddenly wanted to buy. Late is when your neighbor who knows nothing about markets is talking about gold at a barbecue. Late is when mainstream financial media is running gold to $10,000 headlines. Early is now. Early is when the data supports the move but the crowd hasn't caught on yet. Early is when you can still buy without competing with panic buyers. And make no mistake, there will be panic buying. When the next crisis hits, when the next bank fails, when the next currency collapses, people will rush to gold like they always do. And the price will gap up so fast that you won't be able to get in at a reasonable level. I've seen this movie before. I watched it in 2008. I watched it in 2011. I watched it in 2020 when COVID hit and gold surged from $500 to $2,000 in months. The pattern is always the same. Slow accumulation, sudden recognition, explosive move. We're in the accumulation phase right now. The recognition phase is coming. And when it hits, it's going to be violent. Now, let's talk about what could go wrong with this thesis because I want to be intellectually honest here. What could stop gold's rise? The Fed could somehow engineer a soft landing, bring inflation down without crashing the economy, and restore confidence in the dollar. That would be bearish for gold. The U.S. government could implement serious fiscal reforms, cut spending, reduce the deficit, and put the debt on a sustainable path. That would be bearish for gold. Global tensions could ease, trade could normalize, and the dollar's role as reserve currency could be reaffirmed by all major nations. That would be bearish for gold. Do any of those scenarios seem likely to you? Because they don't to me. And more importantly, they don't to the central banks that are buying hundreds of tons of gold every quarter. These are sophisticated institutions with access to data and analysis that we can only dream of. They're not buying gold because they're scared or emotional. They're buying because their models, their projections, their understanding of the system tells them it's the right move. When the People's Bank of China buys gold, they're not speculating. They're positioning for a future they see coming. When the Russian central bank accumulates gold, they're not gambling. They're preparing for a world where the dollar is less dominant. And when dozens of central banks around the world are all doing the same thing simultaneously, that's not a coincidence. That's a coordinated recognition of reality. Here's the bottom line. The market is preparing for something. You can see it in the gold price. You can see it in central bank behavior. You can see it in the disconnect between paper and physical markets. You can see it in the geopolitical realignments happening in real time. The question isn't whether something is coming. The question is whether you'll be prepared when it arrives. Gold at $4,300 isn't expensive. It's early. Gold at $5,000 won't be expensive. It'll be fair value. Gold at $10,000 might seem expensive, but it'll just be reflecting the reality of currency debasement that's already happened. The move is underway. The smart money is positioned. The central banks are buying. The supply is constrained. The demand is accelerating. The monetary system is cracking. Everything is pointing in the same direction. The only question is whether you're going to act on what the data is telling you, or whether you're going to wait for permission from people who don't understand what's happening. Because by the time everyone understands, by the time it's obvious, by the time your financial advisor calls you and says, maybe we should look at gold, it'll be too late to get in at these levels. The market is preparing for a shutdown, not a government shutdown, a system shutdown, a reset, a repricing of everything based on the reality that's been building for decades. And when that happens, there are only two types of people: those who own gold and those who wish they did.